That boost ended up being smaller than some had feared. Geopolitical risk factors, though, also giving support to oil as tensions between Russia and Ukraine intensify. Joining us now is Arjun Murti. He is a partner at energy consultancy Veriten that invests in the energy sector. He's also a board member at ConocoPhillips and Liberty Energy. And Arjun, it's great to have you back on the show. So let's start right there. The jump we've seen in crude oil, how much of this is the OPEC dynamics? How much of this is the fact that we have geopolitical risks specifically around Russia and Ukraine and also negotiating dynamics involving Iran?
Yeah, it's great to be back. And I think it's not just those two dynamics, but also the fact that oil has been very oversold. There were a lot of concerns that the trade war would lead to recession at a time that OPEC was flooding the market. And we've seen some of those tariff trade war concerns ease. We've seen the hard data, so to speak, hold up better than the soft data. In oil markets, that's refining margins doing better. We're entering a seasonally better period. And all these things have conspired to, I think, cause that sort of oversold condition oil to start reversing here a bit.
So you like oil at these levels? You think it goes higher?
I think we're starting to take off the worst case for oil, which was that we'd test the 50s and even $40 oil if we plummeted quickly to recession due to a trade war and OPEC was flooding the market. We're now seeing signs that faster than they usually do it, E&P companies are cutting back on CapEx. There's more talk and recognition that the best days of shale are increasingly behind us. And I think where markets also starting to recognize the view we've had, which is that OPEC may not have as much spare capacity. Yes, they have some to bring on. They're not bringing it on at an otherwise great time. But maybe we're starting to get towards the end of how much they can bring on after perhaps this increase and maybe one more after this.
Arjun, how exposed is oil to the potential storyline for the back half of 2025 that supply has been pulled in because of these 90-day tariff windows and some consumers, particularly in the working class, are getting tapped out?
I think that's the still key risk period to remain for oil. So as I mentioned, we're going through a seasonally better period for demand, the summer driving season in the U.S., the air conditioning season in the Middle East. These are big near-term demand drivers. I think there is concern that when you get into the fall, that would also be the time where we're going to reconcile, is the weakness in the broad economic soft data correct, or will the hard data kind of win the day? If we do get kind of a little bit of a weakening in the hard data at a time of seasonal weakness for oil demand, I think that's your next big risk period. But I might also call that perhaps the final risk period. Again, these signs that shale is peaking and OPEC is running through its spare capacity. You're setting up for a pretty good upside over the next couple of years. You just have to get through this demand choppiness that you're alluding to.
Right, and which makes me wonder if it is just a little bit of choppiness or if the data is just a little bad, might that provide support to people who are longer term bullish on oil and have the price go up because at least the nearer term worries perhaps evaporating?
I mean, that's exactly right. And I think the real question on oil from an investment standpoint is, what is your horizon? If you're trying to be a short-term trader, I think there is legitimate concern to worry about the middle to back half of this year. But again, this shale has been 90% of global oil supply growth over the last decade. And there's no one who believes that we can get that kind of growth going forward. And we're at a time, we're just coming out of all this energy transition mania where people said, hey, we're not going to need crude oil anymore. That is proving to be not true. And yet no one's trying to find oil. Everyone's doing, understandably, stock buybacks, dividends. We support all that stuff. But at some point with global economic growth, when it returns and all the economic needs of the rest of the world, you're going to need an oil supply. Now, is that second half of 2025? Maybe not.
Okay.
But as you get into 26 and 27, I think that's when you start thinking about a stronger potential upside for oil markets.
Arjun, I know you keep saying the best days of shale are over, but I also realize you have permitting reforms happening. You have deregulation happening. There was a big Supreme Court decision that actually moved in favor of enabling more infrastructure to be built in places like Utah. There's a sense from some of my conversations with people in the industry that Utah could be the next big area where you see investment and oil production coming forth as well. How are you handicapping some of those dynamics and what it actually means for U.S. oil production, maybe being more resilient?
I actually love where you're going with this question, because this is what's needed. So we are very supportive of having permitting and regulatory reform and infrastructure reform. And we do need to think about, in a world where the Permian Basin is not going to grow as quickly, it's still going to be a big and important basin. We need to look towards Canada, and that requires infrastructure. We need to consider Alaska, in particular, the National Petroleum Reserve of Alaska is a very prospective area, as well as places like Utah. And I might even say California, believe it or not, actually has oil. And maybe they are deciding shutting down the oil industry is not such a good idea. So I think trying to figure out where we can go as a country to ensure that we have a substantial oil production, which has been so beneficial to us. That is going to be one of the big questions, and permitting reform, you're absolutely right, is a key driver.